On Friday, June 5th, the U.S. government reported that the American economy added 172,000 jobs in May. That's not just good. That's almost double what Wall Street expected. And the market absolutely collapsed. The Nasdaq fell more than 4%. The S&P 500 dropped 2.6%. The Dow shed nearly 700 points. Semiconductor stocks lost $1.3 trillion in market cap in a single session, the worst day for chips since March 2020. So here's the question everyone should be asking. If the jobs report was that strong, why did everything go off a cliff? The answer tells you everything about where markets are right now and what's coming next. Let's start with what actually happened on Friday morning at 8:30 Eastern. The Bureau of Labor Statistics dropped the May Employment Situation Report. Here are the three numbers that mattered. Non-farm payrolls came in at 172,000 jobs added. The consensus forecast from Dow Jones was 85,000. That's not a small beat. That's more than double what economists expected. The prior month, April, was revised down slightly to 179,000. Unemployment held steady at 4.3%. That matched the forecast exactly and was unchanged from the prior month. Average hourly earnings rose 0.3% month-over-month and 3.4% year-over-year, both in line with estimates. On the surface, this looks like a Goldilocks report. Jobs are being added. Unemployment is stable. Wages are rising but not out of control. So why did traders immediately start selling? Because in the current environment, a strong labor market doesn't mean rate cuts are coming. It means rate cuts are off the table, and rate hikes might be back on. Here's the dynamic that's been in play all year, and that Friday's report made impossible to ignore. The Federal Reserve has one primary mandate right now: get inflation back to 2%. Core inflation is still running well above that target. And the Fed has been clear. They are not cutting rates until they see sustained progress on inflation. A labor market that adds 172,000 jobs when everyone expected 85,000 is not a cooling labor market. It's a resilient one. And a resilient labor market means consumer spending stays strong, which means inflation stays sticky, which means the Fed has zero reason to cut. But Friday's report went further than just killing rate cut hopes. It actually moved the needle toward rate hikes. After the data hit, the 10-year Treasury yield surged above 4.53%. The 2-year yield jumped 11 basis points to 4.16%, its highest level since February 2025. And on the CME FedWatch tool, traders fully priced in a Federal Reserve rate hike by December 2026. 70% odds of at least one hike before year-end. 60% chance of a move as early as October. Let that sink in. 6 months ago, the market was pricing in multiple rate cuts. Now it's pricing in a rate hike. That is a seismic shift. And Friday's jobs number was the match that lit the fuse. Now here's where the day got truly ugly. And it wasn't just about the jobs report. The catalyst that turned a bad day into a historic one came from Broadcom. The company's AI chip guidance came in softer than expected, and that single data point triggered a cascade that wiped out the entire semiconductor sector. The Philadelphia Semiconductor Index, the SOX, fell 10.3%. That is the single worst day for chip stocks since March 2020. During COVID, AMD fell 10.86%, closing at 466. Intel dropped 11.28%. Marvell Technology lost 8%. Micron fell 6.3%. Broadcom itself slipped 3.8% despite being the one that issued the guidance. Total semiconductor market cap destruction, $1.3 trillion. In one session. This matters because chips aren't just a sector anymore. NVIDIA, AMD, Broadcom. These are the stocks that have been carrying the entire market's AI premium for the past 2 years. When they break down hard, the whole index breaks with them. The Nasdaq's 4.18% decline is directly tied to chip stock weight in that index. Two separate hammers hit the market on Friday: a hot jobs report that killed rate cuts, and a semiconductor sector that cracked on weak AI demand signals. The combination was brutal. Let's put numbers to exactly how bad it was across the major indices. The Nasdaq Composite closed at 25,709, down 4.18% on the day. That is the worst single-day performance for the Nasdaq since April 2025. More than a year. The S&P 500 settled at 7,383, down 2.64%. The last time the S&P had a day this bad was October 2025. The Dow Jones Industrial Average shed 695 points, closing at 50,866, a 1.35% decline. The Dow held up relatively better because it has less tech and semiconductor exposure than the Nasdaq or S&P. What's important to note is the leadership of the selling. This wasn't broad-based defensive rotation. Big tech and semiconductors led the decline. That tells you the market is specifically repricing the AI trade and the rate-sensitive growth trade, not fleeing into cash or bonds across the board. So where does this leave us? The market is now in an environment where good economic data is bad for stocks because good data keeps the Fed on hold, or worse, forces their hand on hikes. That is a difficult setup to navigate. Here are the 3 things to watch over the next 2 weeks. First, June 10th, CPI. The May Consumer Price Index drops on June 10th at 8:30 a.m. Eastern. If inflation comes in hot on top of a hot jobs report, the rate hike narrative gets even louder. If it softens, some of Friday's damage gets walked back. Second, Fed communication. The Fed meets June 17th, 1 week after CPI. Markets are going to parse every word from Chair Powell for any signal on whether October or December hike odds are being taken seriously inside the building. Third, semiconductor earnings guidance. Broadcom's soft AI chip outlook was the secondary catalyst on Friday.